The bond market just sent a warning signal that should terrify every American, and the mainstream media is completely silent. While you were celebrating the holidays, foreign governments quietly began the largest financial retreat in modern history. What I'm about to show you in the next 20 minutes will change how you think about your savings, your retirement, and the dollars sitting in your bank account right now. Because the data I'm holding proves one thing: the greatest wealth transfer in human history has already begun, and 99% of Americans have no idea it's happening. Let me start with a fact that should be impossible. The 10-year Treasury yield just exploded past 4.80% in early January 2025, hitting its highest level in months. Now here's the part that should make your blood run cold. This happened after the Federal Reserve cut interest rates. Read that again. The Fed is cutting rates, actively trying to make borrowing cheaper, and the market is saying no thanks and pushing yields higher anyway. That's not a healthy market. That's a market in open rebellion. When the Fed cuts rates, Treasury yields are supposed to fall. It's basic economics. But right now, yields are surging in the opposite direction. Why? Because the buyers are disappearing. For the first time in modern financial history, the foreign central banks that have been the backbone of U.S. government debt are walking away. They're not just reducing their positions, they're running for the exits. China's holdings of U.S. treasuries have collapsed to just $680 billion, the lowest level since 2008, before the financial crisis. That's down from a peak of $1.3 trillion just a decade ago. They've dumped nearly half their holdings, over $600 billion, in the span of 10 years. And the selling is accelerating. In the last 24 months alone, China has liquidated over $200 billion in U.S. treasuries. India has slashed its treasury position below $200 billion, while simultaneously stacking gold at record pace. And Europe, which collectively holds an estimated $8 trillion in U.S. dollar assets, is now openly discussing contingency plans for capital controls and forced divestment. This isn't theory or prediction. This is published Treasury Department data telling you that the greatest debt bubble in human history is starting to pop. But wait, because what China is doing with that $600 billion they pulled out is even more terrifying. And when I show you the secret gold buying program they've been running behind the scenes, you'll understand why gold just hit all-time highs and why it's heading to $4,700 within 18 months. Stay with me. Here's why this matters to your wallet, even if you don't own a single treasury bond. Rising yields mean rising borrowing costs for everyone. The U.S. government now spends over $1 trillion per year just on interest payments on the national debt. That's more than the entire defense budget, more than Medicare, more than Medicaid. $1 trillion just to service old debt, not to pay it down, just to cover the interest. And that number was calculated when rates were lower. At current yields between 4.5% and 5%, the interest expense is about to explode. We're talking $1.2 trillion, $1.3 trillion, potentially $1.5 trillion annually within the next 12 to 18 months as old low-rate debt matures and gets refinanced at these brutal new rates. But the government isn't the only one getting crushed. Mortgage rates track the 10-year Treasury yield closely. When the 10-year hits 4.8%, mortgage rates jump to 7%, 7.5%, maybe even 8%. At those rates, housing prices have to fall because nobody can afford the payments anymore. Let me give you the numbers. A $500,000 house at 3% interest costs about $2,100 per month in principal and interest. At 8% interest, that same house costs $3,770 per month. That's a 75% increase in your monthly payment. Either prices collapse by 30 to 40% or the housing market freezes completely. Both scenarios are catastrophic for the economy. Corporate borrowing gets annihilated too. Companies that were financing operations and expansion at 4% to 5% are now staring at 8% to 10% for new debt. Highly leveraged companies with debt coming due face a refinancing crisis. They can't afford the new rates. Bankruptcies surge. Layoffs follow. This is the mechanism through which rising yields trigger recessions, and it's happening right now. Now, the reason why demand is collapsing is where this story gets truly sinister. Because China isn't just selling treasuries. They're executing the most brilliant financial strategy of the 21st century, and it involves the one asset that's about to go parabolic. Keep watching. China isn't selling treasuries and holding cash. They're converting dollar assets into hard assets, specifically gold. China's official gold reserves have been increasing steadily. But here's the thing, the official numbers are a lie. China reports adding about 225 tons of gold to reserves in 2023. But independent analysts tracking gold flows through Hong Kong, Shanghai, and other channels estimate the real number is closer to 500 to 1,000 tons per year. China is quietly accumulating the largest gold stockpile on Earth, far larger than official statistics admit. Why? Because gold can't be frozen. Gold can't be sanctioned. Gold doesn't depend on the U.S. financial system. And gold holds value when currencies collapse. China is preparing for a world where the dollar is no longer the reserve currency. And they're preparing by buying the one asset that has held value for 5,000 years. India is following the exact same playbook. India's U.S. Treasury holdings have dropped below $200 billion, while their gold reserves have surged to record highs. The Reserve Bank of India has been one of the most aggressive central bank buyers of gold in the world, adding hundreds of tons over the past few years. This is a coordinated global shift. Central banks in Russia, Turkey, Poland, Singapore, and dozens of other countries are all doing the same thing, selling dollars, buying gold. In 2023, global central banks added over 1,000 tons of gold to their reserves, the second highest annual total on record, and 2024 is tracking even higher. This is what I call the Great Rebalancing. The world is moving out of paper claims on U.S. government solvency and into hard assets that can't be debased by money printing. And now we reach the data point that should be front-page news, but somehow isn't. Central banks globally now hold more gold by value than U.S. Treasuries in official reserves. Let me repeat that. For the first time since the 1990s, the total value of gold held by central banks worldwide exceeds the total value of U.S. Treasury bonds held in official reserves. This is both a symbolic and strategic milestone. It means that central bankers, the people who actually manage money for entire governments, have collectively decided that gold is a safer store of value than U.S. government debt. They're voting with trillions of dollars, and they're voting against the dollar. But the nuclear bomb in this story isn't China, it's Europe. And what European finance ministers are discussing behind closed doors right now about their $8 trillion in U.S. assets will shock you. This is the real endgame scenario. European investors, both public institutions like central banks and private investors like pension funds and asset managers, collectively hold an estimated $8 trillion in U.S. dollar-denominated assets. That includes $3.6 trillion in U.S. Treasury bonds and another $4 trillion plus in U.S. stocks, corporate bonds, and other dollar assets. Europe is the single largest foreign source of capital supporting U.S. financial markets right now. Right now, European leaders are having discussions about what happens if Trump actually follows through on his threats to seize Greenland, annex Canada, or take the Panama Canal. The conversations happening in Brussels right now, behind closed doors, are genuinely shocking. European finance ministers and central bank governors are wargaming scenarios where the EU imposes capital controls to prevent further investment in U.S. assets. They're discussing coordinated sell-downs of Treasury holdings. They're analyzing what happens if Europe weaponizes its $8 trillion in dollar exposure as retaliation for American aggression against European allies. And here's the thing, this isn't some fringe conspiracy theory. This is being discussed at the highest levels of European government because European leaders are genuinely afraid that Trump is going to tear apart the transatlantic alliance. And if that happens, Europe's most powerful weapon isn't military, it's financial. Imagine this scenario. Trump moves on Greenland. Denmark, a NATO member, invokes Article 5, claiming an attack by another NATO member. The EU sides with Denmark and against the United States. In retaliation, the European Commission announces that European institutional investors are prohibited from purchasing new U.S. Treasury bonds and are required to reduce existing holdings by 20% over 24 months. That's $720 billion in forced selling from European central banks alone. Add in private investor liquidation, and you're looking at $1.5 trillion to $2 trillion in selling pressure over 2 years. The U.S. Treasury market would collapse. Yields would spike to 8%, 10%, maybe higher. The federal government's interest expense would double overnight. The deficit would explode beyond comprehension. The Fed would be forced to step in and buy trillions in bonds just to keep the government funded. And that means money printing on a scale that makes 2020 look like a practice run. But here's the truly terrifying part. The inflation from that money printing wouldn't be spread globally like it was in 2020. Because this time, the rest of the world isn't holding dollars. China is out. India is out. Europe is selling. Oil producers are diversifying into yuan and euros. The dollars that the Fed prints would stay trapped in the United States. All that inflation, all that currency debasement would hit American consumers directly and immediately. Prices would explode. Groceries, gas, rent, healthcare, everything would double or triple in price within 18 months. Your paycheck wouldn't keep up. Your savings would become worthless. This is Weimar America, and the mechanism is already in place. All it takes is a trigger. Now let me show you what's already happening in the data, because we don't need to speculate about future scenarios. The exodus has already begun. And when you see these numbers, you'll understand why I'm telling you to act now, not later. Foreign holdings of U.S. Treasuries have been declining for months. In the most recent Treasury International Capital reports, foreign investors were net sellers of U.S. government debt. China sold billions. Japan's holdings are stagnant. The Cayman Islands, where Chinese entities park money, has been selling aggressively. Saudi Arabia's holdings are down. Brazil sold. Even traditionally stable buyers are reducing exposure. This is happening while the U.S. government needs to borrow nearly $2 trillion this fiscal year just to cover the deficit. If foreign buyers are selling and domestic buyers are maxed out, who's left? The Federal Reserve, the buyer of last resort, the money printer. We can already see the Fed's dilemma playing out in real time. The Fed cut interest rates in late 2024, trying to ease financial conditions and support the economy. But Treasury yields went up anyway because the market doesn't care what the Fed wants anymore. The market cares about supply and demand. And right now, the supply of Treasuries is massive because deficits are enormous, and demand is collapsing because foreign buyers are walking away. The Fed is losing control of the bond market. And when the Fed loses control of the bond market, it loses control of everything, because the bond market sets the price of money. If the Fed can't control interest rates through policy, it has to control them through direct intervention, which means buying bonds, which means printing money, which means inflation. Here's the death spiral in action. The government borrows money to fund deficits. Foreign buyers refuse to buy at low rates. Yields spike. Interest expense explodes. The deficit gets bigger. The government has to borrow even more. Yields spike higher. The Fed steps in and prints money to buy bonds. Inflation surges. The dollar weakens. Foreign buyers sell even more aggressively. Yields spike again. The cycle accelerates. This is a debt trap, and the U.S. is in it right now. The only question is how fast it plays out. So what does this mean for your money? Because this isn't just macro theory. This is about your retirement account, your savings, your ability to survive what's coming, and the specific assets you need to own right now might surprise you. If you hold U.S. stocks, you're exposed to foreign capital flight. U.S. equity markets have been propped up by foreign investment for decades. European, Asian, and Middle Eastern money flooding into Apple, Microsoft, Nvidia, Tesla. But if those buyers become sellers, who's buying? American retail investors are already 100% invested. pension funds are fully allocated. If foreign investors liquidate even 10% of their $6 trillion in U.S. equity holdings, that's $600 billion in selling pressure. Stock prices would collapse 30%, 40%, maybe more. The AI bubble would pop. All those trillion-dollar valuations based on future growth projections would evaporate when capital becomes scarce and expensive. If you hold long-term bonds, you're getting destroyed right now. Bond prices fall when yields rise. If you bought a 10-year Treasury at 3% yield 2 years ago, and yields are now 4.8%, your bond has lost 15% to 20% of its value. You're underwater. And if yields keep rising to 6% or 7%, you'll lose 30% to 40%. Bonds were supposed to be the safe part of your portfolio, but in a rising rate environment driven by foreign selling, bonds are a trap. If you're holding cash in dollars, you're exposed to currency debasement. The Fed is going to print, there's no other option. When foreign buyers disappear and the government still needs to borrow $2 trillion a year, the Fed has to step in. And when the Fed prints trillions of new dollars, each existing dollar loses value. Your savings account, your checking account, your money market fund, all of it loses purchasing power. Inflation is a hidden tax, and it's about to accelerate dramatically. The only assets positioned to survive and potentially thrive in this environment are hard assets that can't be printed and that foreign buyers are rotating into. Gold is the obvious one. Gold is at all-time highs and going higher. Central banks are buying aggressively. Wealthy investors are buying. Even retail investors are starting to wake up. Gold doesn't pay interest. Gold doesn't generate cash flow. But gold also can't be debased, can't be frozen, and can't be sanctioned. In a world where trust in government debt is collapsing, gold is the ultimate safe haven. Silver is following the same pattern, with industrial demand adding rocket fuel to investment demand. Commodities and real productive assets like oil, copper, and agricultural land benefit from inflation and currency debasement. Real estate in select markets outside the U.S. or in areas with strong local fundamentals can preserve wealth. And Bitcoin, whatever you think of it, is increasingly being treated by institutional investors as digital gold, a scarce asset that can't be printed by central banks. Here's the brutal reality. For 50 years, the world agreed to hold dollars in U.S. debt because the U.S. was stable, powerful, and reliable. That deal is breaking down before our eyes. Trump's erratic foreign policy is destroying decades of accumulated trust. China's rise is providing a viable alternative system. Europe is realizing it can't depend on American protection or American sanity anymore. And the financial markets are repricing everything based on a world where the U.S. is no longer the unquestioned safe haven. We're not fully in that world yet. The dollar is still the dominant reserve currency. U.S. Treasuries are still considered risk-free by most investors. But the transition has started, and transitions in reserve currency status are historically violent, chaotic, and devastating for the old power. When Britain lost reserve currency status after World War II, the collapse took less than a decade. The pound was decimated. Britain faced repeated devaluations, crushing inflation, and economic stagnation that lasted for 30 years. The U.S. is now at the beginning of a similar transition. Most Americans don't see it because the media is focused on political theater while the actual economy is being restructured underneath us. So what do you do right now? First, understand that dollar-denominated paper assets, stocks, bonds, cash, are all at risk. They depend on continued foreign confidence in U.S. stability, and that confidence is evaporating. Second, diversify into hard assets immediately. Gold and silver are the most obvious choices. Physical metal that you hold, not paper ETFs that can be frozen or confiscated. This isn't about speculation. This is about wealth preservation. If the dollar loses 30% to 50% of its purchasing power over the next 5 years, gold will at minimum preserve what you have and likely gain significantly. Third, reduce debt exposure if possible. Rising rates make debt more expensive. If you have variable rate debt, Lock in fixed rates now while you still can. Fourth, consider international diversification. Not all your wealth should be in dollar-denominated assets and U.S.-based accounts. Fifth, pay attention to what central banks are doing, not what politicians are saying. The Fed will tell you everything is fine until the moment it collapses. But central banks in China, India, Russia, and even Europe are telling you through their actions that they're preparing for a post-dollar world. This is the most important financial story of our generation, and it's unfolding in real time. The bond market is broken. Foreign buyers have left the building. The Fed is trapped. The government is functionally insolvent. And the only way out is inflation, currency debasement, and the slow death of the dollar's reserve status. It's not going to happen overnight. This is a slow-motion collapse that could take 5 to 10 years to fully play out. But it's happening. The data proves it beyond any doubt. And if you're not positioned for it, you're going to watch your wealth evaporate in real terms, even as the nominal numbers in your account stay the same or go up. Your 401k might say $500,000. But if that $500,000 can only buy what $200,000 buys today, you've been destroyed. That's the hidden tax of inflation. That's the cost of currency debasement. And that's what's coming. The exodus has started. China is out. India is rotating to gold. Europe is preparing the nuclear option. Gold is breaking records. Yields are spiking. The bond market is screaming. And the Fed is out of options, except the one that destroys the currency. This is the end game for the debt-based dollar system, and you're living through it right now. The only question is whether you're going to see it in time to protect yourself, or whether you're going to be one of the millions of Americans who wake up in 5 years and wonder where all their purchasing power went. If this video opened your eyes to what's really happening, do me a favor. Hit that subscribe button and turn on notifications for what happened after. The next video is going to cover the specific assets and strategies to protect your wealth when the dollar loses reserve status. You cannot afford to miss it. Drop a comment below and let me know if you're already diversifying into gold or if this is news to you. Stay safe out there, and I'll see you in the next one.